G'day folks, it's Jim here from AudUsd Forex, and it is Sunday the 2nd of May. Well, I thought I'd do a quick outlook for the US dollar for the upcoming trading week, heading into the non-farm payrolls on Friday, which are expected to show an outsized gain of almost 1 million jobs created in the month of April. We did see a bounce in the US dollar on Friday, reversing the recent downtrend, partly on month-end position squaring, I suspect, but also because of some possible positioning ahead of the expected strong jobs numbers, and also helped along on Friday by slightly higher US bond yields heading into the weekend. So without further ado, anyway, we'll go and have a look at the charts and see what they've got to say and see what we can expect in coming days. Okay, so as you can see, this is a daily chart of the dollar index, and as you can see, we had a decent bounce really off the lows. I kind of think we're probably trading in this channel, and we almost got down to reach the base of it, not quite, ahead of this bounce, which took us back above the 100-day moving average, this being the blue line here. And the MACDs do appear to be turning a little bit higher. So in the short term, I think we're possibly got further gains ahead of us, and really I'm looking at pushing on to sort of 92 and a quarter for the index. That equates to around 119.30 or 118.80 up here against the euro. So I think we could see further weakness in the euro just over the next few days, but I don't think I'll be getting too carried away with it, and I suspect actually it'll probably be a better buying opportunity for the euro as we head towards these higher levels. Now, if we move ahead and look at the weekly charts, actually before we go to the weekly charts, I should just say that I don't think we're going back down here in the next couple of days below this sort of 90.60, 90.45 level. If we do break this, I think then we're going to see an increase in the US dollar downtrend, but I don't think we're going to see that for the coming week, and so we'll go and have a look at the weekly charts, which are not quite so bullish in the long term. Here we are. You can see this channel, and the MACDs are they're pointing a little bit higher perhaps, but turning a little bit more neutral, and I do suspect we're probably going to chop around until Friday, although we have got the manufacturing PMIs out on Monday. We're going to have a look at the calendar in a minute. So my view is that we probably head from this sort of 91.30 level up towards 92, possibly 92.5, but I don't think we're really going much further than that. And so with that in account, we'll go and have a look at the euro charts. Okay, so here we have an hourly chart of the euro, and as you can see, it's been in a steady uptrend really well, this is back to the beginning of March, end of February. And we broke down on Friday below the 100, 200 and the first FIBO support level. And although the hourly charts are somewhat oversold, I suspect we're probably heading back down towards this, well, below 120, and we get down here to 119.80, and then I think we can possibly even go further. As I said before, 119.30 to 118.80, somewhere around there. It wouldn't surprise me to see us back down there over the next couple of days. The 4-hour charts are pointing a little bit lower. While we were making this uptrend, we were seeing degrees of bearish divergence. So I suspect this move on Friday has probably got some momentum behind it, and we can drift a little bit lower. The dailies also are looking a little bit toppish. So I suspect a move towards this. The brown line here is the 55-day moving average. The pink line and the FIBO level 119 to 40, and below that, as I say, well, I think we can possibly head down to 118.80. That might be too far off at this stage, but certainly down around this level, if we see it there, I'd be looking to buy it for the longer term. The reasons really for that being that sustained US dollar upside seems somewhat limited given various Fed officials recently reiterating Jerome Powell's resolutely dovish stance at recent meetings and speeches that he's made outside the FOMC. We've got commodity prices continue to surge, and it appears that in certain sectors supply can't keep up with demand. Europe's accelerating vaccination program suggests to me that we should see some support for the euro in coming months, although we do have the upcoming German elections in September, which might add a little bit of uncertainty, but I think that process looks to be going fairly smoothly. But also I think with Joe Biden's rescue package due to set in the second half of the year, the amount of liquidity in the system will probably see the US dollar come back under pressure. And so from that point of view, I'm really looking to buy dips in the euro and eventually push beyond this high, beyond what's 121.5, back up to here 122.5, and possibly even to test 123.5 later in the year. But that's some way off at the moment. In the meantime, as I say, I do think we can head back down towards here, 119.5, possibly back down as low as 119.80, down around here. And like I say, I think buying dips is probably the way to go. What that means for the other currencies, we'll just go and have a look at some of them. Sterling I'm leaving well alone. As you can see, it's very choppy. This is a 4-hour chart of sterling. Now if we go back and have a look at the equivalent 4-hour chart of the euro, they look completely different. And I do think if we're going to play one of the crosses, euro sterling, long euro sterling looks a good bet to me. We're going to have a look at the charts there. I kind of like the fact that I think euro sterling can head higher. Although, having said that, from what I read in the press, the UK economy is set to outpace the EU economy in the second half of this year, which should be supportive of sterling, but I think there's other political issues there as well. But from a technical perspective, at least, I prefer to be long of that cross. Elsewhere in the US dollar sphere, the Aussie, here we have the Aussie, that's a 4-hour chart, and that looks a little bit heavy to me, although we're not really doing anything. A bit like sterling, we've got this pivot line here. We broke above it, haven't really made a move on. We've come back to test it and sitting fairly close by. I do think in the short term we've got some downside ahead of us. The 4-hour charts are beginning to point a little bit lower. The dailies not showing us an awful lot, and we are sitting on the 100-day moving average, so maybe the Aussie doesn't move too far. As I said, with commodity prices going through the roof, I think the Aussie will stay relatively well supported. But for the time being, I think we might just see some better levels to buy some dips down around this sort of area here. So 76.5, 76.40. I'd be looking to buy Aussie down there, looking for the next leg up. I won't bother with the other currencies. They're not doing an awful lot that really interests me at the moment. But I will have a look at euro sterling. Okay, so here we have a 4-hour chart of euro sterling. And while the indicators are not showing us an awful lot at the moment, mainly because we've been sitting in this sideways range, it appears to me that we could be ready to break to the top side. Now, depending on where you draw your trend line from, either these lows here or sorry, these highs here, meeting this level, or this peak here, it seems to me we're plugging up against resistance. But I do suspect we are about to move higher, as the weeklies will show us. If so, there could be some quite reasonable upside. So 87 sort of 15.20 looks to be resistance, and again at sort of 80, where is it, sort of 87 30 40. So that's not going to be easily taken out, I don't think. But if and when we do, we'll move along to the daily charts, and we can see on the dailies that if we reach this sort of 87.60 level, we're coming up against the 38.2% FIBO retracement and the 100-day moving average. So once again, that's going to be a bit tricky. But this kind of does look like a reverse head and shoulders to me. If we can take these sort of levels out here, the weeklies, I should say the dailies aren't showing us a great deal at the moment, but the weeklies do seem to be turning a little bit higher. And if we can take this out, the pink line and the blue line that are meeting here, they come in at 88.35, that being the 200 and the 100 week moving average, and that's kind of what I'm looking for. I wouldn't want to be long much more than that, so I'm kind of looking to be long at the moment. I have been long for quite a while, but I'm looking to square the whole thing up in the 88 figure to 35 level if and when we see it. So that's about it for the currencies. Very quick look at the stock market. Okay, so here we have a daily chart of the Standard & Poor's 500. I've got a pretty open mind on this. There's no point arguing against the uptrend, but it does seem to me that one day we're waiting for a little bit of an accident to happen. We probably need to, I mean, it wouldn't actually hurt, I don't think, if we came back to sort of the 4,000 level, just to clean some of the froth off the top of the market. and if we broke through there, we've got the 100-day moving average down here. It's just about 3,900. That kind of seems a long way off at the moment, and a lot of money's been lost in calling tops in the stock market over recent times. But in the near term, a short-term pullback would not surprise me, and I think it's actually quite healthy. As Joe Biden's rescue package gets underway, I then think we probably start to head higher again. So in the long term, I do remain bullish, but I wouldn't be wanting to buy it at these sort of levels. I don't think 4,200 was kind of where my long-term target was, and for the time being, it still remains. So I guess by the end of the year, we could see 45, 4,600. But right now, as I say, with the charts kind of looking very, very overdone here. The weeklies are quite overbought, and as you can see, the RSIs are really running out of strength. So, as I say, I think a pullback would not hurt at all, and that would give us some breathing space for the next leg higher if and when we see it. So that's about it. Finally, I'll just have a quick look at gold because I find gold quite interesting. Now, the gold chart I've got here is really, it's a long-term theory play on a technical outlook. For those of you who've never heard it before, go and have a look for a cup and handle technical formation. You'll find explanations of it on the internet. But briefly, following an uptrend, you get this long-term rounding bottom, then you get a correction. If and when it breaks above the resistance level, you can expect to see a price target equal to from the bottom to the resistance line. So starting from here, so over the long term, gold $3,000 an ounce. That's this is suggesting in a very, very long term. So don't get excited because these monthly charts are still well overbought. But it's just something worth considering for a long-term outlook, I think. The resistance, or if you take the resistance from the equal top here, so that's sort of 1900. Realistically, I think you probably need to get it back above 2000, 2100 even. So I wouldn't get too excited about it yet, but it's worth putting in the back pocket. In the near term on gold, where I'll go back and have a look at the MT4 chart, and here we can see from the 4-hour chart that gold's really not doing anything really very exciting at all. Just stranded really below this sort of $1,800 and above, well, I guess above sort of 17, 20, 30 level. So it's going sideways. It's not really doing anything very exciting. The dailies suggest we're in this channel, possibly capped by the 100-day moving average. We haven't been above there since we fell below it, which is when that was back in January. So we haven't been back above there since. The 200-day moving average comes in here, roughly equal with the top of the channel, so 1860. So until we get to 1860, I'm not really even excited about gold, but we'll keep an eye on it. As I say, in the long term, it may just be a great trade out there, but it is a very long-term thing, as I say. Okay, so that's about it. We'll have a quick look at the calendar before we sign off. Okay, so looking ahead for Monday, the main points of interest really are the manufacturing PMIs. And then late in the day, both the Fed's Williams and Jerome Powell will be speaking, so they'll be very closely watched, of course. On Tuesday, we have got the RBA interest rate decision. No change expected there, and the interest will all be in the statement. And not forgetting, of course, that it is the Australian budget following Tuesday, the 11th of May. Then later in the day, there's not an awful lot that stands out as being overly exciting. Wednesday we've got New Zealand unemployment figures, and then the rest of Wednesday there's not an awful lot out. We've got the ADP numbers, of course. They're expected to show a rise of 808,000 jobs apparently on Wednesday, so that'll be a precursor to the non-farm payrolls. We've got the ISV services PMIs as well. Thursday is UK Bank of England Day. Once again, no changes expected there, and it will all be in the Governor Bailey's speech and statement as to how things look there. China trade balance on Friday, but realistically, everything's going to be hanging on the non-farm payrolls. As I say, just under 1,950,000 jobs are expected, and the unemployment rate is expected to drop from 6 to 5.7%. So that'll be interesting to see what happens there. So I think it could be quite a good week. Right now, I prefer to be mildly long US dollars, but realistically, for the bigger picture, I'm still looking to sell dollars into short-term strength, looking for a weaker dollar as the month and the year progresses. So that's it for this week. Have a good week's trading, and we'll talk to you next Sunday. Cheers, bye.